I'm Chris Preston.
And I'm Brad Simmerman.
Welcome to Street Check, the best two-person podcast in the history of Cabot Wealth Network. Uh, Brad, I changed this to best two-person podcast a while ago, realizing that we have a couple of our analysts who, for their paid advisories, have individual podcasts that they do, including Tom Hutchinson, who runs Cabot Dividend Investor, Cabot Income Advisor, who has a very entertaining opening to his weekly podcast, where he says he's coming to you from the Hutchinsonian Studios. Then made me realize we don't have a studio name, partly because we have two studios, we call them. So I just wanted to pitch you an idea. We talked about this in our company Slack, and most of the ideas were ridiculous. The one I was going to pitch was Green Mountain Cactus Studios, because I'm in Vermont, you're in Arizona. What do you think? Do you have a counter?
Yeah, my counter is Simpress Stonerman Studios because
Yeah,
that's the Hutchinsonian version is like both of
I
our
know.
is an amalgamation of both of our last names. I don't know. I feel a little bit cheapened by Green Mountain Cactus because it's like, hey, what's in Arizona? I don't know, cactuses,
Yeah,
cacti. That's all they got.
yeah.
I don't know. I feel a little bit disrespected off that. I don't have a better pitch. If I had
I
a
mean,
better
Gila
pitch,
Monster. You want it to be something like
no,
that, or I'm trying to think of other Arizona
I've been out here
stereotypes.
20 years. I've never seen a Gila monster other than in a zoo. Uh,
Tumbleweeds.
well, yeah, we have tumbleweeds.
Yeah,
I
Oasis.
don't know, rattlesnake,
Yep.
snake bite. Now, but any rattlesnake is going to be co-opting D-back stuff. I don't have a great pitch. I'm going to continue
Okay.
to lean on Simpra Stonerman.
How about Madison, our producer? Do you have
At
anything?
the Madison Studios. Just forget both of you guys. Let's not try to do this like meet in the middle thing.
Okay,
Let's just the real star of the show, the Madison Studio.
here's the actual answer. Madison Avenue Studios,
See?
right? Like,
Perfect. Bam. That'll look great on a t-shirt.
Ooh, that's actually pretty good.
yeah, I know it's pretty good. That's why I said it.
I know, but you say a lot of things on here, and a lot of times you have to eat your words.
Yeah.
That one I actually like. If Madison approves, then
Yep.
we'll go with that. I'll go with that in the next intro. Madison Avenue Studios. Okay. Done.
Glad we got that settled.
Yeah, I'm glad we solved that. Okay. Brad, tell people what we're going to talk about today.
So this week, in lieu of a big three, we are going to go with a starting five, where we're going to spend a little bit more time talking about more topics. We are going to talk about the market's rebound from the early August correction, a pretty impressive, like 8-day streak going until yesterday. We are going to talk about Powell's comments in the Jackson Hole keynote this morning, what that might mean going forward. We're going to talk about the disappointing, maybe not disappointing, but we're going to talk about the jobs revision that came out earlier this week. We are going to talk about the EV makers. Is there value there? Are they like oversold? Is there an opportunity that people are missing? And then we are going to discuss whether space is the next obsession of Wall Street, whether it can fill in the sort of gap of AI fatigue, where
Space,
AI has
the
been
next frontier. Is that what
yeah,
you're trying to say? Yeah.
yeah,
Okay.
it's the final front. Well, God, I
Oh,
hope
I've
it's not the
never heard
final
that.
frontier. That's probably bad news for the equity markets if
Yeah,
space is
that's
the
why I said
last
next.
thing.
Yeah. Yeah.
But yeah, so we're going to talk about that a little bit, and we'll just spend more time on more topics.
Yeah, and yeah, there's a lot going on, so it's a good week for that. And but first, as always, is our defend the take segment. And Brad, you're up for this week, and your take, for which you have 90 seconds to defend. So Nvidia reports earnings, I believe, next Wednesday, so August 28th. I think that's right.
Yes.
There will be no Nvidia earnings beat will be good enough for the market. You have 90 seconds again. Go.
So this leans a little bit into, I think, what's going to be a reoccurring theme this episode, which is the market is pricing in, right? The market is fairly good at pricing in about 6 months down the road. AI has been driving this market for going on 2 years now. Wall Street seems to be ready for the next hot stock, the next hot sector. Nvidia is trading at 75 times earnings right now. It's a $3.16 trillion company. Expectations are that they're going to come in with 2.87 billion in revenues and 64 cents a share in earnings. Because it's so far divorced from its fundamentals, and because it's been driven so much by the meta narrative, I don't see I don't see an outcome for Nvidia where an earnings beat is enough to significantly drive the share price higher. Um, because at that point, you're entirely relying on momentum and growth and the prospect for the future. And we have spent the last year plus acclimating ourselves to AI being the driver, being the next huge economic opportunity. Um, and the market has AI fatigue. I don't think there's any getting away from that. Nvidia lost almost 20%, maybe exactly 20% in the correction that we just had in early August. It has bounced back. It's done so very impressively. So it's trading right near its highs again. But I just don't see there being a lot of room for a re-rate for a big earnings beat if it comes in, which I think it's unlikely to beat earnings because of the delays with Blackwell. But even if they beat, it's AI and Nvidia seem pretty topped out right now.
Yeah, I mean, it's fun if they had reported like a week ago, I think it could have seen a big bump, but I think it's like you said, it's recovered. That's the key point. It's recovered almost all of its losses. And there are steep losses from, see, like topped out at 135, actually all the way back in mid-June, but was close to almost right back there in July 10th. From that, fell from 134 down to 98 by August 7th, and now it's right back up to 128 as of this recording. So it's essentially recovered just about all of its losses. I agree with you that AI has grown stale, and we'll talk about this later when we discuss the space, your space theme. People are looking, I think, for a new, exciting trend to latch on to, and I don't think Nvidia holds the sway over certainly doesn't, I don't think will hold the sway over the market in terms of, like, even if it gets a 5% bump from earnings, I don't know that the market will move the way it has in the past, year and a half, when, what is the opposite of when Nvidia catches a cold, the market gets a flu.
When Nvidia sneezes, the market catches a cold.
Yeah, but the good version of that, whatever. When they get, a silver medal, the market gets a gold, something like that, just to, going off the Olympics just completing. But I don't think even if it gets a little bump, I don't think it'll, to your point, will move the market the way it has recently.
Yeah, and the other thing that sort of factors in, and I'm going to contradict myself in a second, but the other thing that I think factors in is that, like you said, dropped from 134 and change to 98 in the span of about 2 weeks. That is an opportunity for anybody that felt like they missed the boat to buy in. That's an opportunity for anybody that wanted to double down ahead of earnings to buy in. I don't know who else is in the woodwork that's going to step in and buy. Now,
Right.
the exact same thing happened in April. Nvidia's earnings were May 21. We had the April sell-off that looks, if you look at the charts, they're nearly identical, with Nvidia selling off in the April correction, bouncing back, and then trading sideways into earnings. And then they had a big gap up. I just don't think we get the gap up this time.
Yeah, I think it was a little, May versus now, end of August is different in terms of AI fervor. I think there is AI fatigue, absolutely. And I think that was part of the, not just Nvidia, but market pullback, which was sort of led by, all the AI stalwarts from, the previous year and a half, Nvidia, Microsoft, Supermicro, it all really pulled back a lot. And while they've recovered a lot of those losses, I don't think there's not I think people are looking for something different than AI, especially with as much sort of uncertainty in the market. And sorry, go ahead.
Oh, yeah, I was just adding on to that seasonality. September historically a bad month for the markets.
Yeah.
So you're coming right off of earnings into the teeth of what is generally a bad month as people do some portfolio repositioning back from the summer. So
especially prior to an election. that there's all the more uncertainty. Okay, let's move to our starting five this week. Number one, the market. Had an 8-day, just completed 8-day winning streak, the longest win streak, at least the S&P, all year. And then today, it's getting another bounce after a couple sort of down to flat days. S&P is almost back to its late July highs, mid-July highs. Not quite. NASDAQ's a little further behind because it dipped further. I mean, it dipped, 13-14%?
Yeah.
S&P was more like 8.5%. It's funny, Mike Santolo, who runs our growth investing advisories, he's still, I think, as you noted, maybe it might have been on a company meeting or something, still pretty skeptical, it seems. But I think mostly because you normally don't see, market collapses as much as it did in the span of a few weeks, and then just immediately, a V-shaped rally, or just bounces right back this much, which is essentially done. And B, I think some, I don't know that growth stocks as a group of, really outside of some of the AI bounce backs, I don't think as a group that they've really taken off in a way that suggests that this is it. This is the next phase of the rally. Where do you stand on, where the market goes from here?
I think that maybe so Mike wrote a daily end of last week that was basically running through three options. One would be the V-shaped recovery. He does not make predictions. He's smart like that, unlike us. He's like, follow the evidence and that's it. But I'm not gonna make a prediction. But he looked at the possibility of maybe a V-shaped recovery, which we have been sort of setting up until I think yesterday. The possibility of a W-shaped recovery where we go back up, we retest some higher levels, decline from there, and then bounce back and sort of resume the uptrend. Or one thing that I think he thinks is more likely than a lot of us would have in July is the bottoming process, where we chop around for a little bit. We let some of the macroeconomic stuff sort of play itself out. I think I'm maybe more in the W recovery or the bottoming process camp. I'm still overall bullish. I don't see a lot of stuff out there that changes the narrative that significantly would impact the market going forward. But from a technical standpoint, we closed the gap down in early July on the NASDAQ, and we recouped the 50-day moving average, which we had fallen below in the second half of July. And now we're moving sideways, but we're moving sideways at sort of a lower level. So we seem to be consolidating. Maybe seasonality comes into play in September and pulls us back down, or maybe we just move sideways for a little bit and sort of catch up. That was that was sort of what we saw earlier in what we saw earlier this year, where in May, we were moving pretty sideways, but at higher levels. So I'm still overall bullish. The long-term trend remains intact, but I wouldn't be surprised if it was a process that takes some time to play itself out. Maybe September sucks and then we start heading higher into October and into the end of the year. But I mean, we'll talk about the Fed later, but when rate cuts hit, who knows? Yeah,
exactly. Let's just transition into that now. Jerome Powell, what's sending stocks higher today? Powell came out today and said the time has come to begin cutting interest rates, which means all but certainly they'll be starting to cut, as everyone already knew or figured, be starting to cut rates at the September meeting. By how much, we'll see. I still think it'll be just a 25 basis point rather than 50 basis point. But that him saying it is, there's a difference between speculation and confirmation. And this is confirmation. So investors like it. The market likes it. But there still might be, I guess I wonder, especially given, how September and first half of October typically play out. Usually those are not great months for the market, and especially ahead of an election. But I wonder how that might change the narrative. I think today could be kind of the high point, because I think there probably is going to be an element of buy the rumor, sell the news, because this has been sort of known, not 100% known, but 99% known for a few weeks now. It's what sort of spurred on the rally. The absolute certainty that the Fed was going to start to cut rates next month. And now that it's confirmed, we're having a nice moment today. But, I wonder as we get into September that some of that, sort of interest rate cut bump will start to fade, even when the cuts happen themselves, because it's already known.
Yeah, today was
unless they do 50 basis points, which would
I can't imagine.
I don't think they will. No.
Like that's I mean, like we always do the like, oh, okay, well, I'll eat hot sauce if I mess this one up. I'll eat my hat if they come out and cut it 50 basis points. I do not see that happening.
Eat hat. Let me just write that down. Eat that. Okay.
I'll
eat the hat that Madison puts all the hot sauce things in. Yeah.
Yeah, I'll eat that hat.
Yeah.
Yeah. So today had a very mission accomplished feeling to it, right? Like Powell came out in Jackson Hole, stepped on the stage. The time has come for us to start cutting rates, or I don't remember the exact language, but that was effectively what he said. The thing that's in the back of my mind is inflation was transitory until it wasn't, and then once it was clear that it was not, the rate hiking continued and it even accelerated. If they think that they are on the glide path to the soft landing, to inflation normalizing, and one of the things that they brought up was that like a lot of the job weakness is coming from normalization and not coming from economic weakness. I do think that they're setting themselves up to do what they've been doing this whole time, which is take longer than everybody hopes to make moves and to be very data dependent.
Mm-hmm.
That's been what their talking point has been, is data dependency. I am wondering if we get more than one cut this year at this point, because if they slow roll it the way they slow rolled raising rates, then that would point to a 25 basis point cut in September for me, and then them waiting to see how is this going to sort of matriculate up or matriculate through the economy.
Yeah, I think him saying time has come, I would be surprised if we just get one 25 basis point cut before the end of the year. I think, as we said last week, I'd be surprised if they do it. Was it November 7th, the next one after September? I'd be surprised if they do it the same week as the election. But December, I'm not going to say I'll eat my hat or anything like that, but I feel very confident that they'll do two cuts and probably just 25 basis points each in September and December. Mark me down for that.
That does seem like the most likely outcome.
Yeah.
Because then they've got the smoke screen of coming out and saying, hey, we cut in September. We're going to see how that affects jobs in the economy. And we're going to take our time and see if the data supports continued rate cuts. So the November, they will have already given us the one rate cut by the time the November meeting hits. They can sort of smoke screen it and say, hey, we're just waiting to see how this affects the economy. And then if they are concerned about the overall strength of the economy, that second cut comes in December. That seems like, I mean, I'll pull up CME Fed Watch and see what people are pricing in right now.
Yeah.
But that seems like the most likely.
Yeah, you're right that the Fed chair coming out and saying the time has come to cut rates is the crescendo. Like that's the news. Them actually just following through and doing it, again, shy of them doing it by 50 basis points in September, I think is not news. I think that's not going to move the needle, one way or the other, really.
All right. This made me chuckle and caught me off guard. Right now for December, per CME Fed Watch, the market is pricing in a 23% chance of 2 cuts, no chance of just 1 cut. I'm sorry. They're pricing in a 23% chance of 3 cuts, no chance of 1 or 2 cuts only. They're pricing in a 44% chance of 4 cuts and a 27% chance of 5 cuts. Yeah,
There's only 3 more cut dates.
Well, so yeah, so they would have
they
to have
think 50 basis points for at least one of them.
Yeah, so
No way.
their market is pricing in 50 basis points for one, and then either 1 or 2 other rate cuts. I remain firmly in the sort of 50 basis point cut is the ceiling, but I wouldn't be surprised if it was 1. This definitely feels like the market getting ahead of itself. Will you eat your hat for this
one? They
did
this last what, November,
March?
Anytime after he says things, they get way overexcited. And
Yeah.
that was the whole, they're definitely going to cut rates at least 3 times. What about 6 times this year? And we're still sitting here in late August and they still haven't actually cut the rates even once. And you and I were skeptical then. Jacob Mintz, I was, both our options trading expert and sort of a market realist. He was skeptical. How is it that you and I sitting, in our, taupe backgrounded living rooms? Yours is gray.
Mine is.
Yeah, blends with your shirt.
Reliable gray, something like that. Anyway, continue.
Yeah. How is it that we can? I mean, I guess we could be wrong here, but we haven't been so far. So I'm just leaning into it. I think that people must be just too close to it. I think if you work on Wall Street, or if you're an economist and you just, you hear the words, the time has come, like, oh, they're going to cut it by a full basis point, 1 whole percent or something, whatever they're thinking. No, I would say I'd say 75 basis points max, and I'd be surprised if it's even that.
I had to double check and make sure that I was not looking at like December of next year. The idea of a full percentage point cut is staggering to me. I think people sort of forget the fact that like from the rate recession until we started seeing rates come up in like 16, 17, and then again post pandemic. So from like 2008 through like 2022, that was a 0 rate environment for the most part. But natural rates for the Fed, like the Fed funds effective rate, naturally sort of has been around 5%. And like the economy is a lot different now than it was in 1980, but it's not much different than maybe than what it was in say like 95. This seems like a pretty reasonable terminal rate, or maybe we get down to 4% over the next year and a half, something along those lines. But I'll eat 2 hats. I'm going to have like a hat debit that is going to be staggering at the end of this year if the Fed cuts 1%.
If we have an episode where you're eating 2 hats, everyone, you can't just do audio for that. We're going to direct everyone to our YouTube page for that one. Okay, let's move on. Jobs numbers. We got another alarming number that came in this week. 818,000 jobs that you'll say this right more than I will. You go ahead.
So the jobs added from April of 23 to March of 24 was revised down from 2.9 million.
Yeah.
It was revised down by 818,000 jobs. So that's 30% less jobs growth. And it's the largest downward revision since 2009. So it's not insignificant. There was an analyst that came out, and I can't remember who it was right now, saying that part of that may be attributable to changing how they were counting undocumented workers. Where they were including them in the unemployment rolls and are not doing so any longer. So that 818 might be a little bit overstated, but it does sort of normalize something that we've talked about a little bit with, anecdotally, it feels like for a lot of people out there, the jobs market is tougher than maybe the headline numbers are showing. At the end of the day, even with the revision, it's still really strong jobs growth. We still added 2 million jobs, give or take, in the last year. That's solid. I do think that the market maybe got caught off guard by the headline figure of 1 million jobs being in range.
Mhm.
So that
So it
we
seems like
haven't,
it being short of that,
yeah,
people were like, okay, not worst case scenario or worse than the worst case scenario,
right.
versus last month, only what was it, 100 and some, way less than projected, jobs added in July, that really caught people off guard because there hadn't been that big a shortfall in a long time. Whereas I think it helped. I think you're right. It helped. They, before releasing the official number, said there could be as many as 1 million jobs, fewer
Yeah.
jobs in the last. Does it go back till March?
So it goes from April of 23 through March of 24. So it's a full 12 months. It's April through
Oh,
March.
okay. Yep.
Um,
Um,
it also was released in a sloppy way. It was delayed by like 45 minutes, but supposedly Mizuho and Bank of America and a handful of other investment banks had the data available ahead of times. So I think it wasn't like rolled out across all major news outlets in a way that was impactful from a headline standpoint. I think more than anything, the
that goes
market
barely
has,
news, you
yeah,
know?
yeah. I think the market
Whereas-
had priced it in was the
Yeah,
big.
whereas like the official jobs number from last month sent shockwaves all the way to Japan, who created this whole carry trade thing. This like barely moved the needle this week. But yeah, I think, I mean, part of it just, people are trained to uh, going backward, to a year. Doesn't affect anything in the last even 6 months or 5 months, I guess. Um, it's a lot for people to sort of process. And I think, the fact that the market had built up another head of steam didn't hurt. But this didn't take the wind out of its sails. And yeah, I mean, it could be that in the big picture, people still see that, jobs growth overall has been good this year, just not as good as people thought initially.
Well, and employers were making hiring plans based on this weird supply chain shock of post-COVID. Everybody has excess savings. Everybody's got pent-up travel demand. Everybody's spending at the same time. And if employers are making adjustments based on that being the new normal, and maybe have started adding employees or started hiring in or started the hiring process in anticipation of demand continuing like that, just the normalization is enough to get employers to maybe pull back and terminate some contracts before people come on board. I bet that's probably a big part of it.
Mhm.
But it's also, I mean, it's also survey based, so it's sort of naturally not perfect. I think the next revision comes out in February of next year is when they have like the quote unquote final numbers. So I do think that we're seeing, I think maybe one of the sort of themes of this episode is like things are normalizing and
Yeah,
we are correcting from the over corrections that we had before.
right. Okay. We've done our macro talk for the week. Let's get into a couple more fun subjects. Electric vehicles. Um, they were all the rage pre-pandemic, early pandemic. You hear, Cabot, our newsletters. I think there are more newsletters that had electric or EV recommendations than not, I would say, ranging from companies that you rarely hear anything about anymore. Polestar, Nikola, remember that one?
Yeah,
I think we talked.
workhorse.
Yeah,
Yeah,
Workhorse. Yes. What was that? Workhorse was electric
that,
trucks, right?
yeah, that was Nikola's electric truck, I believe. Right?
Oh, I thought Workhorse was a different company from Nikola.
I don't think
Anyway,
so.
yeah, okay.
Maybe it is. I don't remember. So I mean, case in
Yeah,
point,
anyway,
though,
my
right?
point is that they were all, you heard about all these companies back then. Now you don't hear about it as much. And, what you hear is that Tesla is struggling, and it has. Now, what Tesla's share price is up in the last month or two. But the fact of the matter is, Tesla, went from, growing 50, 70% sales, 50, 70% a year in 2022 and 2021 to down to 19% last year. And then this year, the first quarter of this year, they're their first negative sales growth quarter, down 8.7% in the first quarter, and then only grew by 2.3% last quarter. There's been single digits or less for 4 straight quarters. Rivian is down in the latest quarter, is down to 3.3% growth after being no less than 80% growth in any quarter of the previous several years. It's been a bad time for electric vehicles. Now, reasons behind that, I wrote about this the other day. People have, and we've talked about this before, people have pivoted to hybrid cars, hybrid, electric, gas and electric vehicles. I have one myself, as I wrote about the other day on the Cabot website, a Volvo. And, it's reflected in the data from last year. Americans bought a record 1.2 million electric vehicles last year, up 46%. But hybrids sales grew 65%. And 10% of all new cars purchased in the US in 2023 were hybrids versus just 7.6% for pure electrics. And I think that trend has accelerated this year, where I think there was a lot of excitement about the idea, the concept of electric vehicles when, it was sort of a new thing. I mean, Tesla's been around for a while, but then when new companies like Rivian, ones we mentioned, Polestar and Workhorse, BYD, and even that BYD's sales, I think, were negative in the most recent quarter, which is a huge departure for them. There's all this excitement, and then as we've talked about, I can't remember if it's a Tim Lutz sort of credo here at Cabot, or if it's a Mike one, I don't know. That there's sort of the romance phase, and then you eventually hit the reality phase, and the reality phase has arrived. And while electric vehicles are not, 46% growth last year is still pretty solid. I think that's going to be a lot less this year. It's not like they're not growing anymore, but hybrids have become sort of a happy medium. And the reality is, for people just aren't quite ready to go all electric yet, whether that's due to costs, whether that's due to, not enough plug-in stations. Hybrids sort of at least I know I can find a gas station. I don't know if I can find a charging station. It's sort of a happy medium for people, and the reality phase is here, and it's been bad news for electric vehicle stocks. I guess my question is, are they too oversold? Because they've really gotten beat up of late. I'll let you go for a second. I'll look up some numbers.
Yeah, it's so hard because, like you said, it's not like an established sector with like a ton of companies that are all churning out EVs, and we've got like a bunch of peers that we can value. You look at a company like Ford that trades at like 6 or 7 times earnings. They lost $132,000 per F-150 Lightning, which was their fully electric Lightning. And that's just like their CapEx spend that's sort of amortized over the total number of vehicles that they sold. I don't know if they use the same figures for like the Mustang Mach-E, but like all these legacy automakers are trying to sell EVs. BYD is probably in a better position as a pure electric play. They're trading at 20 times earnings. Tesla is trading at we'll look it up right now, but I think it's got to be close to 40 to 70 times earnings. Yeah, they're trading at 61 times their trailing 12 months earnings. Tesla also has other unrelated companies, SpaceX, which we'll talk about a little bit later. Does Musk personally own Twitter? Does Tesla own a chunk of that? I don't know. I think he just personally owns all of it. But there's not like a sector that we can just look at and be like, okay, well, here's what we would expect for the valuation for the sector. The big boys are all losing money. Toyota never got into all electric. They were just like, hey, hybrid, which I think is the right move. Like I am the exact guy that you would think would buy an electric car. I don't drive a ton because I work from home. My gym is a few miles away. We have 2 vehicles. Both are like mid-sized SUVs. We could have like a road trip vehicle and an electric car, and we've just sort of not taken the plunge because like you see the horror stories of the guy that pulls up into like the Safeway, the double door entry for the grocery store to like plug into the outlet because all the electric car chargers have their chargers cut, or because there's no other outlet anywhere else. And people generally want to do the right thing, but they also don't want to completely overturn their lives to get there. And hybrid is kind of the sweet spot. I mean, like if I have to buy an EV company, I'm probably buying BYD.
Yes. Yeah. And, I've been high on that one for a while. Its latest quarter shows that even it is feeling the effects of sort of this pullback in sort of EV fever and transition to hybrids.
The other thing is China with them, though, right? Like China's its own mess. Their economy has not bounced back in the way that a lot of people were expecting and were hoping, certainly.
They'll need to expand, and then they're in the process of doing it, but they'll need to expand in a meaningful way beyond the Chinese market to, really become a true sort of global Tesla competitor. It's clear it's their price cutting, or cheaper prices, I should say, have really thrown off Tesla off its game in China. But they need to become more of a global presence. They have, no one knows what BYD is. There are no BYDs in the US until it gets into, I guess it doesn't have to be in the US market, but it needs to be in more markets to expand. But I guess my takeaway is this: if you were to buy, given them the valuations are technically, they're not undervalued on a pure valuation basis, especially given the recent pullback in growth. If you were to buy an EV stock now, Tesla, BYD, Rivian. I mean, Rivian has done nothing but fall since it came public. It came public at like 130 a share in November 2021. Tough timing. And down to 13 a share now. If you were to buy any of those now and hold them for a year, would they be up? I don't know. I don't know that they would be. I think we might still be in the EVs might still be in sort of this uncertain reality. But if you were to buy them now and hold for the next 5 years, the next 10 years, I think you'd make pretty good profit. And, I think given the maturity of the companies that put out hybrids like Ford, Honda, Toyota, Hyundai, I think you'd probably do better than those companies over the next 5 to 10 years buying one of the few EV companies, EV stocks. But in the next year, it's a coin toss.
So, I mean, one thing that I was thinking about is like, all right, well, BYD, none of like the bigger EV makers are really pure play EV investments. Tesla is driven very much by Musk and by the other companies. BYD is driven very much by China. The other big EV players are mostly legacy automakers, so they're all very different stocks to buy. Rivian is something of a turnaround name. I think the risk with Rivian is that people might be hesitant to buy a Rivian vehicle based on what happened with Fisker. So Fisker's Ocean, once Fisker started the bankruptcy process, it basically, you can't get parts, you can't get service. It's not, they haven't exactly gone out and like bricked the cars, but if you're left holding a Fisker right now, you might be in a tough spot, and you're going to be looking at like aftermarket service or aftermarket parts or something like that. Like you lose out on a lot of the advantage of owning the EV, which is maintenance is easy, repair is easy, or it's all handled by like this one central company. So I don't know, maybe Rivian, if I wanted to try and make a pure EV turnaround play that's sort of disconnected from other investing themes that could have an outsized impact, like China, like the legacy auto business, that kind of thing.
Yeah, Tesla has Musk baggage, BYD has China baggage, Rivian is and the case for Rivian, it did seem to, at least temporarily, bottom in all the way back in April, around in the mid eights. It's now up to 13, almost 14 a share. Got as high as 18 a share in July. So it is on the right track, but the fact its latest quarter sales declined 3% for the first time in its history is at the very least a yellow flag. So yeah, given that, next year, like I said, who knows? But I do think if you bought Rivian shares now and held on to them it's like, no matter what happens, I'm going to hold on to the next 5 years. I think you did pretty well.
Yeah. As long as they avoid the doom loop where it's like, I shouldn't have to worry about how good your company is when I'm already trying to assess how good your product is, right? Like the quality of a stock shouldn't influence whether or not I'm buying a vehicle. That shouldn't be part of the calculation. But if it is and is persistently part of that calculation, I think what ends up happening is people are like, well, I'm not sure if I'm going to buy a Rivian, and then their sales disappoint, and then the stock declines, and then people who would have thought about buying a Rivian say, well, the stock is down. We saw what happened with Fisker. That sort of doom loop, if you can avoid that, I think Rivian is an interesting play at least, and it's at least pure EV without that baggage.
If you have the stomach for some volatility, for sure. Okay, last but not least, speaking of volatility, space. Has Space's moment arrived? It feels like it, but I guess just how much of a tail does it have? AST Space Mobile is the big attraction right now because it's a space-based broadband company that's launching next month, or supposed to be first half of next month. They have their rockets ready to go at Cape Canaveral now. That's up like 200% more in the last couple months. And you wrote about another one the other day. I'll let you cook here a little bit. Something called Rocket Lab.
Yeah. So we have talked about like the AI narrative sort of falling off, and my pitch with this one was, is space the new meta narrative? Is there enough there to make it the sort of target for something that we have also talked about previously, which is return seeking behavior? For the time being, big institutions aren't getting more invested. Individuals mostly aren't getting more invested. We're moving money around. We're looking for opportunity. That seems to be the sort of dominant trend right now, at least ahead of rate cuts. Once rates start getting cut, then we might have to deploy more capital to other areas that we haven't yet. But one of my questions was, is space a viable target for that meta narrative, that next sort of opportunity that people have been discounting? ASTS is up somewhere around 600% this year. It's up 160% in the last month. It has gotten a ton of attention. They have a launch in early September. We've talked about it a little bit. There's
we talked about it last week.
Yeah, there's space-based broadband. They have service agreements with some of the wireless providers. I know AT&T, I think Verizon as well, where they're going to offer like space cellular coverage. But
it's like direct to smartphone coverage. From
it goes straight to your iPhone from a big satellite. In addition to ASTS, which has gotten all the attention and has had the biggest gain, Rocket Lab is a vertically integrated space company. They're up 30% in the last month. Currently they have the Electron, which is their small lift satellite. It puts about 300 kilograms into low Earth orbit, which is like a fraction of Falcon 9, which is SpaceX's rocket, that I think has like 12 to 20 kilograms is or 12 to 20,000 kilograms, I believe, is their payload size for low Earth orbit. But the thing that's been attractive for Rocket Lab for a lot of investors is that they have their own Falcon competitor that is supposed to be getting launched middle of next year, is the expectation, called the Neutron. They just test fired their Archimedes engine, which I don't know how many engines it will take to go into the Neutron, but they're sort of scaling up for production there. They've got a ton of contracts They've got a pretty big backlog for companies that are already paying an elevated fee to get satellites into space on their smaller launchers. And the U.S. Space Force has rolled out a targeted, it's a more intentional sort of bid process, not even bid process, but a more intentional availability process where it's going to onboard a lot of these smaller companies. So they have talked about launching a possible competitor to Starlink. Starlink has been about 99% of SpaceX's volume in the last year, just based on the number of satellites that they've put into orbit. That is by far the biggest product that's getting put into space right now. But as a side effect of that, they have what they call a ride sharing program where other companies can essentially pay like $6,000 per kilogram to put a satellite into orbit, which is opening up opportunity for, zero G research, for other communication services, other space operations systems. It very much feels like we are in the early stages of a commercial space race in a way that it hasn't since like 2001 or 2021, maybe 2019, when we had Blue Origin, when we had SpaceX that was just starting to get out, just getting started. Basically, all the billionaires competing to be in space, Virgin Galactic, right? So it feels like we're taking another bite at that apple. I just don't know if I'm too close to it.
Yeah. I mean, you're going to be on one of those rocket launches in the first half of September. People don't know that.
God, I
yeah,
wish.
no, it's funny. It's funny we transitioned from EVs to this. We talked about the EVs having their romance phase, 4 or 5 years ago, 3, 4 years ago. We're in the romance phase for space now. How long that romance phase lasts, we'll see. Space is a very different animal from cars. A little bit more difficult for people to wrap their head around. But the opportunity for it to be sort of a revolutionary, not just idea, but sort of movement here, is enticing for people. So I guess it just depends on whether. I don't think this will supplant AI as like the driving thing. AI. So many companies. How many companies was it during a couple quarters during their earnings calls referenced some sort of AI, whether they're
50% plus.
Yeah, it's not like 400 or 300 of the S&P 500 is going to be talking about their space connection next quarter. But this little niche has the potential to have, be the sort of the next exciting thing on Wall Street. It seems like Wall Street is searching for right now, given that, as we talked about at the top, that there's some AI fatigue there. So I think Wall Street will need more themes to latch onto, but it does look like this could be one of them, at least for the coming. We'll see how long it lasts. Weeks, months, I don't know.
So the last time space was a big thing, was like 2019 end of 2019 through early 2021. We had just about a little bit over a year if you just look at the price performance of Virgin Galactic, of SPCE. So maybe that's a similar lead time.
Yeah, I think the top was when Jeff Bezos wore that cowboy hat in space. Then people were like, all right, I'm out on space.
Yeah, that was exactly right. The one that I like is Rocket Lab, because they're vertically integrated. They're on they have parts and components because they make satellites and they make components as well. On 38% of, I believe, the non-Starlink satellites that are getting launched. They're 60% of the non-SpaceX launches. They do have the potential, I think, to be the best competitor to SpaceX. Whether they ever scale up, I don't know. They have
ticker symbol for Rocket Lab
is RKLB. They're up, like I said, about 30% in the last month. They do have a partner that I believe is selling a big stake anytime it runs up too high, or a former business partner. The other one, so that one would be my pitch as sort of like the next SpaceX, or the most viable SpaceX competitor. The other one that I was looking at is Redwire. It's RDW. They're down about 5% in the last month. if this turns into a narrative, the thing that they offer is they're sort of a wild card. They've got a lot of irons in the fire. They just acquired a sort of space-based biotech research firm. So they're going to have a lot of like non-monetized high potential ideas. Whether they ever turn those into anything, I mean, that's going to come down to the research and funding and stuff like that. But that's one for me to keep on my radar.
Up
There,
5% today, RDW.
oh, is it? Nice.
Yeah.
The other one I want to flag is ARC-X. And I want to flag this for a bad reason. That's the ARC Funds aerospace. So we have been critical of Cathie Wood in the past.
Yeah. Well, once you said ARC funds, I was immediately out, but go ahead.
The one space company they don't own is ASTS. The best performer out of the entire sector is the one company they have no exposure to. They have Kratos Defense, which is a drone company, KTOS. They've got like Archer Aviation and stuff, which I think we've talked about a little bit. But the one they didn't have is the one that has been like the figurehead for this sort of nascent new commercial space race. Cathie Wood lost the game before she even knew she was playing. I don't know. She makes a lot of money. She can take it.
Why do they keep doing this? They keep getting it wrong.
Yeah.
I real quick, and then we'll wrap things up. I went to years ago a bachelor party in Brooklyn where the brother of the groom to be, we went to this great steak place in Brooklyn. It's like, I don't know if it's world famous, but very, very locally famous. I'd been there before, really good. I can't remember the name of it. And he was like, "Don't worry, I got this. I'm ordering all rare steaks for everyone. Just," he's like, "Trust me." And we all looked at each other after, like, I wish those had been medium rare or medium, or they weren't. The rare part killed it for me. I feel like that's Cathie Wood. She's like, "No, I'm gonna do things a little differently. I don't want ASTS, the space company that's obviously killing it right now. I want something, everything else." And she's been like that with growth stocks in particular for months, years now. Anyway, that's my Cathie Wood rant.
Yeah, I had to bring it up. I had to bring up there's like one viable space fund. It is an ARC-X fund, and it's also it also doesn't own the one name that has been the best performer for the last year, or the last calendar year, also, or not calendar year, but year to date has been the best performer. I don't know, it's sort of a jewel in the crown of ARC funds to just always be off a little bit, just to miss it, and just
they're
we had
constantly
Nvidia, we
overthinking
sold it.
Yeah, they're constantly like, I know this is good, but really try this. I know Broadway is great, but let's try off Broadway.
Yeah.
They're getting it. They're trying to do their own thing, and they're almost always wrong.
It's a deconstructed salad where it's just a pile of radishes, and it's like,
Right.
Hey, I get what you're trying to do, and I get the objective, but this is not hitting. Just give me a Caesar salad, and we'll call it a day. Yeah, ASTS. So the big thing with ASTS launch in the first half of September, if it doesn't go well, if the satellites don't deploy, it is bad news for shareholders. Be aware. I had a couple of also RANs that I just wanted to flag that have been performing well. Planet Labs, PL, it's up 9.7% this month. And then SIDU, it's up 9.2%. I don't have any insights on those companies, but the ones that I'm keeping an eye on are Rocket Labs and Redwire. SPCE, Virgin Galactic, I think is a known quantity, right? We talked about that with like AI fatigue. There is probably a little bit of SpaceX fatigue with it being a known quantity. It doesn't have the same attraction as some of these unknown companies that are just getting pressed now. Probably stay away from the ARC fund.
Yeah, well, yeah, always. That should be our takeaway at the end of every episode. That's a good way to stay away from the ARC funds.
Don't buy ARC funds.
Yeah. Okay, I think that's we've gone on long enough. Thanks everyone for joining us today, and we're happy to come to you from Madison Avenue Studios. And we'll be back next week. Do want to mention before we sign off, next Tuesday at noon Eastern time, Cabot is I'll be moderating sort of a 4-person analyst panel that'll include Mike Santolo, the aforementioned Mike Santolo, Tom Hutchinson, dividend expert, Nancy Zambell, who runs our, we've had on here before and runs our stock of the month, and the Cabot Money Club advisories, and Tyler London, small cap expert, will all be on the panel. It's free. If you want to join, sign up, go to cabotwealth.com under webinars. Just sign up there. The name of it is Boost Your Profits, 4 experts and their top picks for fall 2024. So they'll each have a pick. They'll each sort of have their forecast for the rest of the year and their top picks for the coming months. So tune in for that. Sorry, go ahead.
Yeah, if you like the podcast but you don't like me, that's what you'll get.
That's the
there.
place to be.
Yeah, exactly. You'll get all Chris and all Cabot analysts and no me. So
this is exactly like what we did at the end of July, minus Brad, when we had 4 analysts on. So yes, this is an anti-Brad. This is your chance to avoid Brad. Well, thanks again for joining us. You'll get more Brad. Your chance to get more Brad for the Brad Hive will be next Friday, and we will see the Brad Hive.
Oh man, I think that's a thing now.
It's going to be a thing. I'm going to make it a thing. All right, we'll see you next week.